I'd like to thank everybody for joining me today. Today, I want to talk about using irrevocable life insurance trust for the planning, helping our clients plan with this type of a tool. And I think this tool, a lot of advisors quit using them. As the estate exemption has increased, a lot of advisors think these are only for people that have an estate tax problem. But it can be used for so many more of our planning, areas and helping clients to achieve the goals that they have. When you start looking at, life insurance and how we utilize life insurance, one of the things we have to focus in is who should be the owner of that policy. And as we're looking at, that owner, are we looking at, the estate tax issues, creditor issues, family distribution, control of the principal and income after death? All of these things are going to drive us to getting the right owner for this policy. Now, that can be an individual. And if it's going to an individual, great, they get the asset, have that ownership, they can control it. But if it's owned by the individual or even a revocable trust, that is not asset protected. The credit, depending on state law, of course, but it might be the right answer. Do we want it owned in the business? Or do we want it outside of the estate, away from our creditors, completely isolated as an asset inside of an irrevocable trust? And so as we start looking at these planning opportunities, take the time to say, who should own this policy? And of course, that's going to drive us to the beneficiary of that policy as well. When you look at planning is a balancing act. We're always, it's if in a perfect world we wouldn't have a, limit on our money, we wouldn't have a tax issue. But as we start looking at this balancing act and we're using irrevocable trust, what assets should we transfer into the trust? Of course, we're going to, as we look at that, it's a question of, should it be in the trust? How much of that should be in the trust? When we're looking at the estate side, well, if we move it into an irrevocable trust, we're not going to get a step up in basis. But if we're moving a life insurance policy into that trust, step up basis isn't an issue that we even have to think about. But we also want to look at our client. What about their lifetime needs? If we're using that life insurance for the living benefits or access to cash value, well, if we don't plan right, we may move that asset away from our client and their ability to use that policy during their life. There again, could be the right thing. We just need to make sure that we know that we're getting them in the right position. As we look at irrevocable trust, and especially irrevocable life insurance trust, the big part of this is we're getting it out of the estate. Now, that's out of the estate for estate tax purposes. That's also out of the estate for asset protection purposes. Now, that's, in a lot of cases, I'll see if we're doing this for estate taxes, well, we can move that in there. We put a second to die policy because we plan for the tax bill to come due at the second death. Well, that's great. That trust is going to work probably just how it needs to. But I look at this and say, especially where the insurance industry has gone, and we build a lot of these policies for lifetime benefit, cash value access, living benefits. So can we get it outside of the estate, but also add lifetime spousal access and allowing the spouse or can be a child to have access to that policy during their life? So let's take a look at that. So let's take this. We're going to set up an irrevocable trust for the wife. And so I'm using a husband and wife in this example, just so you can see how two parties would set this up. We have the grantor of the trust. In this case, the grantor of the trust is going to be the husband. The husband is going to set this trust up for his wife's benefit, and so that we can get it out of the husband's taxable estate, get it away from the husband's creditors. So we're moving this asset away when we set this up, and we put a life insurance policy in there. That life insurance policy is going to be on husband's life. He's going to move that into the trust. he is going to give up all control of that policy so he doesn't have incidents of ownership that will bring that policy back into his taxable estate for estate tax purposes or subject to creditors in any creditor situation. When we set this up, we can set it up as a grantor trust so that if there's any income tax being generated inside of that trust, we can have it come back to the husband as, paying that tax bill, during his life. Once we get this set up, we move assets in there, the husband's job is done. Now we can have the wife be the trustee of this trust, so she can be the lifetime beneficiary and also be the trustee of the trust. So she's now in control as long as we put the right provisions into this trust saying that the beneficiary can receive access to principal and income during their life. So we would give discretionary power to the trustee to distribute to the lifetime beneficiary during the husband's lifetime. And so we'll hear this as spousal lifetime access provisions. Just remember, we can do this with any lifetime beneficiary, children, grandkids, whoever. The nice thing now, think about what we've created. We've moved the asset out of husband's estate. We've moved it away from his creditors. We've given the wife the control as trustee, and we've made the wife the lifetime beneficiary. So as that policy has cash value in it, the trustee can reach in there, grab money out of there, hand it to the wife, and the wife can go spend that however she wants. But now that money is not locked away from our spouse during lifetime. Upon death, whatever's left in there, so upon the wife's death, she's no longer the lifetime beneficiary. That remainder interest can go to the kids or children, grandkids, whoever we want, and that's going to be estate tax free. We can leave it in trust. We can take it out and give them whatever we want. There again, we look at the control that the grantor wants on this money. During his wife's lifetime, she gets full use of it. When it goes to the kids, we can put the handcuffs. Here's what I like to talk about as we start moving this to the next generation. If we keep this in trust, if we make an outright distribution to the children or grandchildren, once it's in their hands, they can do whatever they want with that money. They can also lose that money to a divorce or creditors or whatever. We can keep this in trust for the kids during their lifetime, and we can provide incentives for them. We can take care of special needs. We can, give them, money out of the trust on those, events like graduation or marriage, encourage them to, be a stay-at-home parent, salary match, whatever you want to do with your money, you can encourage that to the beneficiaries of the trust, the remainder beneficiaries, as long as that money's staying in trust. We can incentivize them to use the money the way you want it. If education's important for you, provide money for that child to go to college, to grad school, whatever it is you want to do. If you want to help them through the retirement years, great. There again, it's your money. How do you want it to be used if you want to keep those kind of handcuffs? You can also have disincentives so that if you have a child that has a drug problem, well, you don't want to encourage them to continue using drugs, but you would use the money from the trust to help them go through rehabilitation and whatever it is. Help encourage them to do the things that you want that are positive, discourage them from doing the things that are negative. But this allows you, as long as that money's in trust, you can keep the keys to that and control how that money's being used. What's nice when we're setting up an irrevocable trust, we can pick and choose which state to set this up. So more states have better asset protection laws or favorable tax laws, flexibility in cost and administration. So we can pick and choose the jurisdiction that makes sense if you're not in a state that you want that trust set up in. Since we're dealing with an irrevocable trust, we have to look at how we get assets into the trust. We can use the annual gift tax exclusion. That brings in some other things like crummy letters we have to address later. We can use our lifetime exemption, family loans, third-party loans, grantor retained annuity trust, sales to a defective trust. All of these are additional tools that we can use to help get the money out of the grantor's estate into the trust, done right, done legally, so that there's no potential of that being drugged back into the grantor's estate by a creditor or by the IRS and then the state tax situation. So when you're looking at irrevocable trust, go beyond, go beyond just the taxes and look at what other things we can help solve for our clients. I appreciate everybody getting on, and if you have questions, feel free to reach out, and we'll talk again next week. Thank you.